Broadcast is now starting. All attendees are in listen-only mode.
Obviously, you guys couldn't hear me because I was muted. Can you see my screen and hear me now? Okay, great. Let's go ahead and get started. Welcome to today's Beginner Circle webinar, where we try and answer questions for those new to Elliott Wave, new to our services, help you find some things on services, answer some questions about Elliott Wave, understanding and using the charts, and then also try and go through some of those things that are usually covered in the Market Pinball Wizard or the markets service of Elliott Wave Trader .net as we go through and answer those questions. So, we have the normal charts that we kind of look over. I try and get, that top down, larger degree context view before we drill down to the more granular levels and then answer those Elliott Wave questions as stuff comes up and show you guys a few of the other things that I'm looking at. And then we jump into those other charts as well. But anything that is, more related to understanding basics of Elliott Wave, certainly those kind of questions get jumped up to the top. So there is still a very slight chance that this was a fourth wave and we're going to try for one more high. Avi hasn't abandoned that on his charts because technically this low did not invalidate as a fourth wave, but most things did fall significantly under reliable support. Also, it looks like 5 waves down. So if this were a fourth wave, it would have to count as a WXYXZ, which is not the most reliable pattern. And again, even if this is a fourth wave, we're clearly getting 3-wave structure initially off the low. And as we'll look at on a smaller degree when we zoom in, the structure that Avi's looking for in a bullish count mimics this structure, at least in terms of a retrace coming soon as a B wave, or in the more bullish case, a wave 2, and then a swing move higher. Just that swing move could potentially get up to new highs. I have that as a very distant bullish potential as an alt. I think it is far more prudent to just look for a measured move into resistance and get very, very defensive later on in the end of quarter one or in the middle of the second quarter of next year for a possible move rolling over as a larger C wave down. That would still be in the early stages of a much larger degree correction. If we did, in fact, top in January, it is the top of the primary wave 5 that we've been following in these webinars and on the site since the COVID March 2020 lows. That's the primary degree wave 5. And that is the wave 5 of a cycle degree move that started all the way back at the 2009 post-2008 financial crisis lows. That's the cycle wave 5. And that's the wave 5 of a larger third that started all the way back in the 1930s after the 1929 crash, and then additional downside petered out. I don't have all of the data got erased from a CSV file, so I have to get that from Garrett, but the wave counts were able to stay, and he's posted that larger count many times. So in terms of a magnitude of correction, we are looking for something that mimics at a degree of magnitude the consolidation that we saw in 2000 or in 1929 to the 1930s. In terms of the parentheses, capital Roman numeral, supercycle wave 3. And that's something that can take more than a decade, possibly even 2 decades to fill out. And one of the things that we've talked about a little bit is that because of there's a couple of guidelines that Elliott Wave talks about in terms of where a fourth wave should find support. One of those guidelines is that the fourth wave is going to look for fib support, either a 23.6% retrace, a 38.2% retrace, a 50% retrace of the entire wave 3. So that's one guideline. We can see that our 236 retrace takes us all the way down to the 928 level, which seems pretty scary from all the way up here. But another more common guidelines are using the fourth wave of a prior degree. So that means that this fourth wave, the supercycle wave 4, is very likely to find support in the same region of the cycle degree wave 4 inside that supercycle 3. So that's the 2000 to 2009 ABC expanded flat consolidation. So that's one guideline, and I think we're really running with that in terms of our ideal zone, starting in the 1600 region and stretching all the way down to the 666 region again. But another guideline is that when you have a fifth wave that's extended, then oftentimes the fourth wave is going to look for support in the region of wave 2 of that extended move. So that means our fifth wave of supercycle wave 3 was extended. So we have a more narrow window from the guideline where this wave 2, the primary degree wave 2, from the April 2010 down to June 2010, which included the May 2010 flash crash, is, it looks like a very, very tiny window compared to this big wave 4. But that really gives us a very, very ideal region of support for our wave 4. And we see that we have confluence with that in the 23.6% retrace, as well as that being within the zone of that prior fourth wave. So those are a couple of the guidelines in terms of the region of where support should be for this larger fourth wave. Another guideline that we look for is the rule of alternation, which says that, a lot of times that your wave 2 is going to alternate structure with your wave 4 is going to alternate structure with your wave 2. So this wave 2 that came from the 1929 crash dropped way, way down, got a little blip of a bump and as a B wave, and then petered out as a slightly nominal lower low into the early 1930s, really counts best as a zigzag, a sharp, deep retrace for that wave 2. So a relatively higher flat consolidation would really fit the bill for in terms of this larger supercycle degree wave 4. So with that, we'd also like to see, we can't rely on it happening at this point, but we would like to see the cycle degree B wave inside of that larger ABC flat for the supercycle wave 4 actually attempt to make new higher highs, but that can be 10 years out from now. The B waves inside of this move are really what's going to take the most time off the clock. When we talk about, the timing of this move, there's going to be some periods of time where we could have just longer sustained downtrends like we had January to October. But then we can spend an equal amount of time in that B wave bounce, October into, May or June, maybe even stretching out more into the summer before this B wave actually tops. And then this C wave could take a while, or it could be a much sharper, quick drop. And then the B wave inside this A wave is what takes a whole lot of time. And then this B wave itself could easily take 3 to 5 years or more off of that A wave low, which puts us back, in the region, if not a little bit lower than the 2020 lows. So that's kind of a big 30,000 feet view of, what we expect over the coming years. But there's still going to be plenty of opportunities inside that structure for trading in both directions. So right now we're still working on the first of the larger B wave bounces. This would be the intermediate degree B wave inside the primary A of that larger cycle degree A in the larger fourth. And most things really look like this should be only the first leg of the ABC moves. So most corrections are counted as ABC moves in Elliott wave. So you have an A move that goes in the direction of the correction and a C move that goes in the direction of the correction, followed by a consolidation in between. So that, when we talk about that fractal Elliott wave structure where everything is a piece of the whole, you have a bigger ABC correction, and then the segment of the B wave inside that ABC correction is itself an ABC move. And then each of those can be, well, the A wave and the B wave are usually ABCs. Your C waves are usually 5-wave moves. So now when we zoom in and look at the smaller degree structure, then we can keep this larger A, B, C for the parentheses B wave in mind when we zoom in and look at the smaller time frames. But most things, even though we're getting close to a 50% retrace of this 5-wave move down, it should really be just the A wave of that wider flat. There we go. So here we're zoomed into a 2-hour chart. This is the tab that I use that has smaller degree structure highlighted on it, and following this on at most of the smaller time frames. So off of the low, we can see we had an initial move that was only 3 waves up. We're calling that the A wave in an ABC structure for a circle A wave that's minute degree. And that combines together for an ABC structure that's filling out into our ideal 100% fib, although this might be ending up a little bit short of that, closer to the 4100 region instead of 4147, but 5 waves up in that C wave inside the circle C to complete the A wave. And we can see we have fibs over here that 4102 roughly is the 50% retrace of the entire move down. I also have this red alt B. I don't have all of the details from that alt count. I try not to put too much extra notes on my chart because I find it a little bit confusing. So I try and keep a cleaner look there. Also ignore all of these issues so we don't have any yelling exclamation marks at us. But it is important to note that while if this was all of an A wave here and a B wave bounce, and this is the start of a C wave down, that this was the best chance for that to roll over sharply as the wave 1 and wave 2 in the start of this red C wave down. But it is still possible that this ABC that we're counting ideally as the A wave of a wider flat for the B, there is a risk that this is completing ABC for a wave 2. So there is also a risk, less of a risk unless it stretches more towards the 4260 region, that this would be completing all of this parentheses B wave. So I'll put that as a faded yellow B up closer to the 618 level, the 4260. So I think the important takeaway, rather than looking at this and getting confused by saying, you put those alt labels on the count, why can't you decide what this is, Zach? Is that whatever it is, we have an ABC structure completing. And we're going to look for an ABC retrace. Now, the risk, if this is the yellow B or the wave 2, is that this retrace that's, a roughly 7%, 8, 9% drop potentially turns into a whole lot more than that. But you can be very, very profitable trimming your profits from a clear ABC move up, tightening your stops, raising some cash, hedging a little bit, and looking for the start of that move. And then if it turns into more, you're sitting in cash. You can add some more short exposure. You don't have to buy in once we get down to the 3,700 region, just because we're at the 3,700. We want to see that clear ABC consolidation that makes for a reliable B wave to trade for a measured move higher. Whether that's a wave 1 and a wave 2, an obvious more bullish count, or the A and the B of just a bigger bounce as the B wave. The important thing is to trade what's in front of you and be aware of something that could be an alternate, more bearish potential, more immediately bearish potential, because this entire structure is the start of something that's a bigger bearish setup brewing. But look for that to, lighten up into resistance. It really should, we only hit a 764 nominally higher than the third inside of that C wave. So at the smaller degree on our SPX chart, we really should see this hold a corrective consolidation in the 3970 region and get a higher high into next week over the 4100 region. Ideally getting close to that 4147. But you have the 200-day moving average at 4060s, and then you have some other resistance there from the 50% retrace of our parentheses B wave is at that 4100 region. So there is a lot of resistance in here for this to top a little bit shy of getting that 100% measured move, but should get a little bit more than this, I think. But the risk skew at this point is certainly down. We can try and squeeze out a little bit more of that higher high, but most of your stops should at least be in this region, because this B wave shouldn't get much below the 3970 to 3950 region if it's going to hold. And once that breaks, there's a good chance that that's already starting the A wave of this bigger B wave retrace. And again, there is a potential that this gets something more bearish than just this ABC retrace towards the 3700s. Just to zoom in on this structure now, we're going to switch over to the ES chart, which I use for much smaller degree charting. And we're going to go to the tab that is the micro counts. And we're going to zoom into the 15-minute there. So because the structure here off of the November 3rd low did not give us a clean 5 waves up. And in fact, certainly in SPX, it's even more pronounced as only a 3-wave move. And this move can be dissected in the SPX as also a 3-wave move. I'm looking more for this to be an ABC move up for the 5th wave. The ES does allow you to squeeze in 5 waves for the wave 1 and 5 waves for the 3. So if that's the case, ideally this would be wave 1, this would be wave 2, and we'd get a 3, 4, and 5 of an ending diagonal. That's probably the better chance of getting up towards the 4160s in SPX or 4155 in ES. But I think we should be more on the lookout for this to complete as an A, B, and a C wave for all of that 5th, a little bit shy of that exact 100% fib. So not going to be upset if it does extend there. Certainly we'll keep some lottos on the table for that to be profitable, but we'll start tightening up my my stops on many things and looking for that larger fade to start once we get closer to the 4100 region. Any other questions on the S&P or ES before we move on? Yeah, I think Avi is just thinking that this is all of the move. And if it stretches a little bit higher, then it certainly does run a greater risk of being all of that ABC for the parentheses wave 5. But as we talked about, there's a lot of good resistance levels that we should really try and attack a little bit. There's certainly heavy resistance, but touching this 200-day moving average in the 4060s, getting more over the parentheses wave 3, trying closer for that 100% fib, or at least the 4100 region, which is the 50% retrace, are all targets that would be more reliable as a top in place if any of those were touched. So until this breaks under the 3970s to 3950 region as support for this B wave in the parentheses wave 5, I'm going to look for it to try and make attempts higher. So on NASDAQ, though, a little bit different. The move that NASDAQ was much more clearly had to be an A and a B and looking for a C wave up, especially heading into the Fed. It was make or break for the NASDAQ. And so we talked about that it didn't count well as being a 4th wave of a leading diagonal for this low here. and it also didn't have room for this to be a B wave in a deeper B wave. This had to be it, and it had to be a 1-2 start, or NASDAQ was going to get really, really bearish really fast. And we got probably one of the greatest single day runs for the NASDAQ off of that. Oh, there was the CPI, not the Fed. Off of that CPI on November 10th. It was like a 7% move, and then it kept going for a few days after. But the thing with NASDAQ now is it got pretty close to a 1-2-3-6 extension already for its circle C wave. And this little jog here or this little jog here, you could count as all of the fourth. So this could be 1, 2, 3, 4, and 5 up for all of that C wave. And now you have a a flat to a lower high off of that low. This might already be the start of either the B wave in white or potentially something more bearish. But I would like to see the NASDAQ try, along with the S&P, of getting closer to that 12,165 level for a 1-2-3-6 fib exactly, or maybe even stretching a little bit beyond that. And otherwise, it's mostly the same as the S&P. I think the threat of the red 1-2 is a little bit greater in the NASDAQ. If that is going to play out in the market in general, it's going to be from weakness in some of the other, tech stuff that's already been beaten up, or really maybe even some of the leaders like Microsoft or Apple that can have a potential similar count as this, or a lot of things in the XLY or XRT ETFs that Garrett and I look at. Tom, we do take a look at oil. We'll do that shortly. I just wanted to look at a few of the other index charts just for slightly different looks. One of the big differences that I see from the S&P and the NASDAQ is in the small caps. The small caps did not make a lower low in October, or even if maybe it was nominal. So there it looks more like this is the A, and a full retrace of the A wave is the B, and they're working on the C wave already in the wider flat. But that could be filling out. That could take just as long to fill out. This can be a leading diagonal for wave 1. It needs more of a wave 2, maybe after more of a B wave bounce here, and then a C wave down for wave 2. It is possible that the small caps are further along, but I think I'm going to fade this to a little bit of a darker red because this looks a little bit better as the leading diagonal. And so I'd like to see this not get much higher when everything else is getting a high. I would like to see some relative weakness from small caps and have that hold as the B wave, get more of the wider retraces wave 2 when everything else is getting its B wave retrace. And then small caps do have some potential to outperform. So instead of only getting a C wave up, they would get the 3, 4, and 5 of the C wave and the B wave. So a little bit different structure there, mostly because these didn't make that lower low. And we do look at GDX as well as the metals, because that is something that Avi covers in Market Pinball Wizard and the market section as well. And I also do an update on those every day in the metals, mining, and agriculture service. All right, so that I think should do it on the market. Let's go now to bonds before we get into energy. So we'll look, this is at US hashtag is the continuous chart for my 30-year treasury. That's the ZB futures. I don't know why they didn't make it at ZB hashtag, but you could talk to IQ Feed, which is my data provider. I'm giving this the benefit of the doubt of possibly trying to start a new cycle wave 5 from a much wider consolidation as the cycle wave 4 in a larger diagonal. So that would mean the cycle wave 5 would be a larger ABC move up over the next few decades to at least attempting nominally higher than we hit in the extreme price extremes for treasuries in March of 2020. But there is a significant risk that that was all of the cycle wave top, where this was 3, 4, and that was all of wave 5. If that's the case, though, we still have a large ABC move down from that high that looks very complete and should be getting more of a corrective bounce. So more of that corrective bounce that fills out might be a larger ABC as that corrective bounce, or that could be the ABC as the A wave of the A wave in that larger cycle wave 5. So I only hinted that more bearish potential, but the path towards that more bearish potential should ideally be the same. We're not going to be looking to hold during a B wave of this magnitude for the possible C wave higher, when we have a clear ABC move up into the 143 resistance region. And again, even if we're thinking that this might be just the A wave of the larger A wave, we're not going to hold for a B wave of this magnitude when this could be all of a larger corrective bounce and the start of a much more bearish move. So the way that I've been approaching, I post, and sorry, I should probably post in the Market Pinball Wizard when I do as well. But in Avi's Market Service, I post a bond update on a regular basis, where I look at the treasuries. Sometimes I look at the 10-year also, but usually just at least this chart as well as the TLT. And we've been looking more specifically off of the low. We were following this move down, looking for the rest of the whole 5 waves to fill out in that ABC move. I'm counting that as a larger Y wave and that expanded flat for the alt cycle, for the cycle 4. But the more important structure is that we have an ABC that looks complete with 5 waves down inside the 5th of the C wave into that last low. We got a 5 wave move up, a deep retrace, but it held a nominally higher low. And now we've filled out more than a measured move. We got extension here today, just past the 1618 extension, but this looks like 5 waves up in a C wave. And that could be the first A wave of our A wave of our A wave of a larger A wave in that bigger corrective bounce. So what we want to see now is a corrective consolidation to set up the next swing wave move. So some of you may be comfortable holding on for a potentially 4% or maybe even a 5 to 6% fade if it's going to get a deeper one like this. I'm very, very light on treasuries now and would like to see an ABC consolidation into the 122 region, 121 region before starting to add back and looking for that next swing move higher. Moving over to TLT. Oops, that's not the right tab. There we go. Let's go to the micro counts tab. So we got this measured move, stretching a little bit further past it. But just as we looked at on the treasury chart, this can just be a little bit of an extension of that 3-wave move up. It does not clearly look like a 4th and a 5th wave. So, we want to see maybe if this holds a high consolidation as a 4th, then maybe there's a play there for a 5th up towards 107. But more likely is we get a bigger pullback closer to the 96 region, and then we can play for the next measured move from there up towards 108, 110 on treasuries. So Tom says, is the bond market correlated to the federal funds rate? Will the Fed money become less relevant as other money bonds will become available from individual lenders? That's something I would probably read up on stuff that Lynn has posted. Our view is really that the people buying and selling bonds are what determine the yield. So the government's going to issue bonds that are paying a certain price, or trying to pay a certain price in interest, and that they have target rates that they set for interest. But the market, the price of bonds is what is going to have an inverse effect on the yield. So it doesn't really matter what the stated interest rate of the bond is. They're going to trade at above or below par, and that needle is going to move on what their effective yield is based on the buying and selling action of individual traders. And that's what we're tracking on the price charts. Okay, let's move on to the energy space. Let's take a look at, where's my macro clean chart? Oh, here we go. Here's our oil chart. QCL is my continuous contract for crude oil. We're initially looking at this as a B wave top here in June and looking for a C wave move down. We filled out all of the subwaves as minimal subwaves for a C wave to normal fib extensions. But a lot of things that Garrett and I were looking at in the energy sector really didn't look complete. So my solution was just to say, well, maybe this was a more stretched out third. We're going to get a fourth wave bounce and then a C wave and then a fifth wave down of the C. But what Garrett posted on USO, I started to add to my crude oil chart as well, because I really liked how it fit with what we were looking at in all of the XLE and XOP names in stock waves. And that was a bigger WXY, where this whole move down was just the A wave of a larger Y wave, in parentheses, of a larger consolidation. And so we have an A, we have a B structure, and then we're filling out an ending diagonal. We got a wider wave 2 bounce here. So we have wave 1 and wave 2 of that ending diagonal down. And ideally are trying to start the C wave inside the 3 of that ending diagonal for the Y wave. And if we can hold right here, then there's a chance that this tries to head up to the 84s again as a wider flat for the same B wave inside that circle 3. But you could possibly count this as 5 waves down now. So if this only bounces up towards the 79.50 to 80 region and then starts to drop again, could be making more of a beeline towards the 60s, at least the lower 70 region. So that's going to put some more pressure on energy stocks that have been certainly trying to go against the trend and get a much higher relative bounce for this wave 2 as an extension of their prior B wave. So then when we look at UGA as the gasoline fund, this is noticeably weaker than a lot of the other energy stocks in general. Got this WXY for the B wave to a 618 retrace and is turned down pretty substantially from there. This can easily be a 1-2 start to the C wave, can bounce a little bit more in a wave 2, closer to 62. They might be heading lower. USO, as we said, fits really nicely, that purple ABC that Garrett had added, and this easily is even just a wave 1 of that C wave down instead of being 1, 2, and A, B of the third. Could even just be a wave 1 and working on a bigger move down for that C wave. So certainly some risk there. We can take a look at, copper is not natural gas. Let's see, here we go. Sorry guys, I was going to try and look at the natural gas chart, but the autocomplete for motive wave makes that very difficult to find. My chart for natural gas is QG, is the continuous natural gas futures. Got higher than I wanted to see for this wave 4. I'm really not very keen on trying to track natural gas closely right now, because I think that this should have been a more significant top. That looked like an ABC structure with a diagonal complete here. So I have a hard time getting overly bullish natural gas, at least from these levels. I'd like to see more of a bigger ABC retrace. Possibly this is all of an A, and this is working on the B wave right now, just without getting a clear 5 waves down inside that C wave. But again, not really a chart that I have a lot of confidence in right now. If it can fill out more of a C wave down into the 3s, then I would certainly be interested. But until then, it's kind of on my ignore list. On oil, Tom, I was looking, there was the potential. Last week, I gave this some bullish potential, that this was all of the C wave. Remember, we had 5 waves down from the C wave. We didn't get 5 waves up, but we were holding as a possible wave 1 and wave 2 of a leading diagonal. And then we had another possible 5 waves up that was not at what you would consider a measured move. So there was a chance that this was a wave 1 and a wave 2, and this is the A and the B wave right here, in the third of a leading diagonal, but gave that a very, very small window to turn up, and it only got 3 waves up as a micro ABC and then turned down. So really, and then from there, it got a quick little bounce and then broke under that support pretty quickly. So, this is not clearly bullish structure off of a new low, and this is not reliably complete with all of the orange 5th wave. Technically, it's valid, but oil would have to do a whole lot from here differently to make me start looking at something more bullish long-term from here. So until then, as long as we're under the 87 to 89 region, the pressure is very firmly still down. All right, let's move on to the metals. Starting with gold, my continuous gold futures contract is QGC. I know that might be a little bit confusing, but that, I don't get to set what the data service provides. So I think everybody's on the same page for the most part in treating this as a wider flat for the primary wave 4. We got 5 waves down inside that C wave, just under the 38.2% retrace of the entire primary degree wave 3 that topped in August 2020, and are looking for our first 5 waves up off the low as wave 1 of the primary wave 5. Now, my preference at the smaller degree is that we completed an ABC move up for wave 1 of that parentheses wave 1 at the intermediate degree as a leading diagonal. So right now we're working on the B wave bounce inside the wave 2 retrace. Then we would look for an ABC move up into the 1870 to 1920 region, depending on where we bottom here for wave 2, and then a deeper retrace, maybe overlapping the top of wave 1, which is allowed in a diagonal, but not necessarily needed. And then getting an ABC move up nominally higher than the third, close to the 1950 region, to give us 5 waves up as that wave 1. So that's my ideal structure off the low. I think in terms of the proportions for what we expect in the larger primary wave 5, that fits the best, particularly with the size of this move. I think we already faded too much for this to reliably be the 4th wave and getting a 5th wave up. So I would like to see it get more of a wave 2 right now in that diagonal structure. Because we didn't start with a clear 5 waves up on gold, though, the other thing that we need to consider is that this is the A wave of wave 1 instead of wave 1 of 1. And basically the difference there is that instead of a wave 2, we can be filling out a B wave retrace. And then we would get a C wave up for wave 1. And the entire structure for this primary wave 5 would be a diagonal. That doesn't mean that it needs to be that vastly different from the structure that we see here. It just means that instead of 5 waves up inside the 3, we would have another A, B, C move, and we could get a deeper wave 4, and then we could get an A, B, C move for the 5th, and that entire structure might fill out a little bit further in time to the right, maybe taking into the 2030 closer to 2030 to fill out rather than over the next 2 or 3 years. I think I put that on one of the tabs. Oh, yes, I put it here. So this is what that diagonal would look like. At the time, I think this is already the B wave. Could still get a little bit higher for the A, but certainly if we do get a higher high as a fifth wave up, it will make me lean a little bit even more to this as a diagonal, just because that'll be a little bit too big to be wave one of this wave one, and a little bit too small to be all of the wave one. So this diagonal would really fit the best, especially if we got a higher high. But in the meantime, this is really my preferred path, is that we fade as a wave two and get a leading diagonal for wave one so that the entire structure doesn't need to be an ending diagonal. Now moving on to silver, that's QSI is my continuous contract. Silver is very different because it is not a fourth wave here off of the June 2020 high. It made a substantially lower low, a much more significant low that could not have been part of a bigger bullish trend. Maybe this is, the start of something else much more bullish. We can count 5 waves up off of that 2020 low and a bigger corrective retrace to a 618. But they're also off of that low. So there is something longer term, much more bullish about silver. I've posted the gold to silver ratio chart, and that could be starting to pivot as well, where silver is set up to outperform. But also off of the relative lows, silver held its September low, deep retrace, but it did not make a lower low like gold did. So we have different structure off of that low. I'm looking for this to get the fifth wave up in this ABC structure for wave one of a leading diagonal, whereas gold looks like it's already wave one and this is the B wave bounce in two already. I would like one more high in silver first, and then to fill out more of the ABC structure for the third from there. Or for wave two first, and then the ABC structure for the third. We can, though, count a possible leading diagonal for this wave one, but it's a little bit messier. And we probably would want this third to be a little bit more muted, the C of third to be a little bit more muted, and then a fourth and a fifth wave. GDX, if we're going to count like that leading diagonal potential, ideally GDX counts the same way, and we'll look at that in just a minute, as silver, where this is an A, B, and working on the fifth of C for wave one of a leading diagonal. But if GDX is in the purple version of a leading diagonal, then this would already be the fourth and starting the fifth. So let's take a look at that now, since we were just talking about it. A little bit shy for that to be all of the wave five, but this looks more like it is starting the fifth wave up already. So I think that this is a much more realistic count. I'm not sure if this was enough for all of that micro B wave. Could still get more of that. But looking really good here and getting our fifth wave up of C. And that will put it, really line up nicely with gold, where it can just retrace as the wave two in the same time that gold is doing it, even though gold is already a little bit ahead, as the B wave bounce inside this wave two already. There was a request for platinum. Again, that's something that I cover almost every morning. We have a significant bottom in September and looking for the initial move up off of that low. The larger structure, I think, is a diagonal, so it's going to have a lot of twists and turns, and we're going to look forward to following that very well. This part of the structure can fit at least with some, it is starting to line up and fall into phase with some of the other metals charts where at least silver and GDX, where we want to see this fifth wave up and then a bigger retrace. We'll take a look at copper also while we're looking at a few other metals. And since there aren't a lot of other questions, copper I think also fits very nicely. Actually fits better with, well, it's purple here. Maybe I'll change this to blue so that it matches what we're looking at on GDX. This is deeper than ideal for the 4, but basically we're counting this as an A, B, and a C wave up for wave 1 of an ending diagonal for a possible 5th, or A, B, C up for a more bearish B wave. So really, holding a retrace after this move completes is going to be incredibly important. And really looks, this structure is a little bit deeper in places than ideal on the copper chart, but give you guys one quick little glimpse of that's purple on that chart because I was following the same thing in purple on FCX as the primary, where instead of this being too small for all of wave 1 and wave 2, in the way that this started kind of choppy, that this looks much more like we are getting the A, B, C up for a larger wave 1 of a diagonal. And again, there is the risk that this is all of a B wave. So trimming a lot and looking for an ABC support for wave 2 to hold is going to be very important, rather than relying on this being the start of a larger 5th wave and holding that wave 2. Saying we got a really nice swing trade from these setups into resistance, we can take some profits and look for another swing trade to emerge. That the structure here does not look like this is part of a nested structure inside of an impulse ready to explode higher. It looks like a diagonal for this C wave heading into resistance. All right, moving on to, I guess we should talk about the dollar. We usually do that. And then I think that might be about it, the stuff that we normally cover. And there aren't any other questions. And I know you guys might be eager to get going for any travel plans or cooking for Thanksgiving. So I think whether we're counting this as just a diagonal up in purple, where this is the 4th and the 5th wave of a larger diagonal, or a very deep primary wave 4 and a large primary wave 5 for a cycle wave C, I think this is a pretty significant top. And I am not interested in being long, the dollar or having direct dollar exposure other than my actual savings accounts until we fill out more of this larger ABC. So that would be the most bullish structure, is a big ABC consolidation at the cycle degree, retracing, all of this leading diagonal or whatever diagonal that is off of the 2008 lows. And if this is an A, B, and 5 waves up for the C wave that hit a 764 retrace or 618 retrace of the bigger move down into the 2008 lows for the dollar, then this could be potentially starting something even more bearish long term for the US dollar, which is very, very good for asset classes that are priced in dollars. So that should help move our metals and stocks and things along. Although the stock, some of the same circumstances that might be forcing this larger ABC correction in the dollar might be forcing the similar ABC correction in the US equities. So equities may not be the good place to hide in terms of benefiting from the dollar destruction of value. All right, we'll go ahead and end there, and I'll get this uploaded for you guys if there are no more questions, and I will see you on Friday and certainly next week. Have a great evening and a very happy and safe Thanksgiving.